I mean, you think about the iconic brands that you know of, and at the end of the day, whether it's Porsche, right? Or it's something like Royal Canin or M&M's, it's about something that people just love and they have an attachment to that they can't even explain fully, right? And that passion is really the seed of it. And yeah, the pet industry has it in spades.
Charles, how you doing?
Good, man. Good to see you guys.
I never know if I should call you Charles or Charlie.
Charlie, please.
Charlie. All right, Charlie from here on out. How you doing? Thanks for coming on the podcast.
Yeah, man. Good to see you guys. Doing all right. Yeah, yeah. Busy season. I know it has been for everybody. You guys been making big moves, staying busy over there too, but doing well in the grand scheme of things.
How's Vetted Capital doing since the fund that you guys raised last year?
Yeah, we're doing all right, man. We just announced last week Dave Vitale, who's an old colleague of mine from Mars, who's the general counsel at Mars Vet Health and did a lot of the veterinary acquisitions and the purchase agreements for him. He's joined us as a venture partner. We've got a couple more announcements on that front coming, which would be great. We got 2 deals that'll be announced pretty soon here, not today, but pretty soon. And then, yeah, so, yeah, grand scheme of things are going well. I feel like lots of deals out there. And yeah, I mean, you guys have seen the market's rebounding, which is good to see.
Yeah, this 2025 has been kind of crazy this Q1. But yeah, for those who may not know, maybe, give us a little bit of the background and how you went from Mars and the things you were doing before and starting Vetted Capital and why you're so kind of bullish on the pet space.
Yeah, thanks, Roy. I mean, look, I've been lucky a lot in my career. I split my career between the Cokes and Mars is probably most relevant for this conversation. But I was there for almost a decade. I got there in 2011 and got really lucky to be based in the McLean office and have a bird's eye view of not just pet, but like their entire portfolio and spend time in the different business units. But always gravitated most to the pet business just because I saw the most opportunity there. And ultimately, we got really lucky. I mean, it's a private company. I can only say so much, but you had a very nice, large, mature, profitable confectionery snacking business, as they call it now, that, chocolate business, gum business, et cetera, that printed cash basically that you could lever and then invest in pet stuff. And pet was growing 2 to 3x as fast as those other businesses. And it's been a very good business for Mars. And so when I was there initially, I want to say, the worst year I was there in the early days, I think it was probably around 28 billion. And, it's always more volatile than most people know. And I think what's publicly reported for 33 billion. And I think post Kellanova transaction will be closer to 63, 65 billion, something like that in terms of top line revenue. And before the pet stuff, I think it would have largely been valued as a food business, kind of 2 to 3 times sales. Let's call it 100 billion. And, before the Kellanova deal, I think if I had to guess, they're probably around 50, 51, 52 billion and would probably trade at a 4x multiple now. So
what is the Kellanova deal?
So Kellanova was the old Kellogg's that split, and the snacking brands, which are Cheez-It and Pringles, and some of the other brands, particularly with a big international portfolio. Mars bought that, and it was, I'll get this wrong, but let's call it a $35 billion deal for something like 13 billion in top line revenue that they acquired across these 2 brands, plus a couple of other odds and ends. And yeah, so I mean, they'll be one of the biggest snacking companies in the world.
And then the transition from Mars into the pet space, or at least Vetted Capital.
Yeah, and so Mars, I mean, like I said, I got enamored with the pet space while we were there. I've also had Labradors basically since I've been married, and I had 2 Labradors that died on the same day as diagnosis with hemangiosarcoma, and wife had to say goodbye via FaceTime both times. The last time was in the middle of a trip to move us from DC to Denver. It was pretty brutal. So I think that too is just sort of always stuck with me. I mean, losing a dog is always hard, but to lose it that way was particularly hard. And to have to be the person that dealt with it. Like first time happened in the middle of a snowstorm in DC, which was just like snowpocalypse. Took me an hour in the car to get up, to Friendship Heights from Georgetown. It was probably like a 3-mile drive or something, but just people in DC can't drive. It's crazy. And the second time was literally, basically halfway between in Iowa City. Yeah, so I think that was another formative experience for me. And while I was at Mars, we set up Digitalis Ventures in the partnership there as more of sort of a strategic enabler. And the first fund was the Human Health Fund 1, second fund was Companion Fund 1. And I just saw how powerful that was, right? And, Ben and the team there are great guys. And I've always sort of thought that it'd be a great opportunity, and I've been surprised more people hadn't been doing it. And being here in Denver, kind of reconnected with a couple guys that I met while at Mars, One, David Howarth, who I was on board with for a couple of years here for a little pet food company that we sold last year. And then Aaron Wallace, a co-founder, GP, who has been part of three companies that have gone into Mars and is just a great veterinarian entrepreneur who was part of the first LEAP cohort. I met him there initially when he was building Lacuna Diagnostics, which sold into Heska. So we just kept talking about this idea of like, there's so many great entrepreneurs, there's some opportunity here, and they're just, there are a lot of buyout funds. They're generalists that dabble at sort of pre-seed and seed, but there's really, in terms of specialists that really just focus on pet, there's the companion fund. And Mars, is 100% of the money. Other than the GPs, right? And so there'll probably be other investors that would want access to that. So that was kind of how we got there.
When you guys announced that, you raised a $150 million fund, was there just an outpouring of, your emails just getting blasted? Because that was, such a, I think, like you said, there's not a lot of, or any doing it. It's just such a unique moment in the pet space. Were you just inundated with emails and people reaching out to you?
To be very clear, we're still raising funds, right? And so I have to be very careful. This is not a general solicitation. I'm not marketing here. I'm just talking to you guys. I'm answering questions. But yeah, look, it's brutal out there. These have been probably the 2 or 3 hardest years to raise capital in over a decade, mostly because so many people invested at the heights of 21, 22 when money was cheap, that a lot of investors, limited partners, allocators who invest into funds are just hungover and, basically bought in at the peak. And then now they're looking at the value of their stakes and they're like, do I want to do that again? Right. And so there are a lot of headwinds in that respect in terms of capital raising. So, it's pretty polarizing. I think if people own pets and they realize how much they spend on their pets, it's a very intuitive thing. Or if they've lost a pet and have a story like mine, it's a very intuitive thing. But for most people, it's the same kind of thing that if you listen to, Greg and Aaron talk about starting Rover or something like that, they'd be like, you're going to do what with your career? Why would you possibly do that? And then, they start to peel back the onion layers a little bit and they're like, wow, people aren't having kids anymore and they're having pets instead. And wow, this isn't just a US thing. This is, has everywhere. And when you look at birth rates, they're falling off a cliff. And you look at, every subcategory in consumer and, pet is one of the stickiest and the fastest growing. And for the past 10 to 15 years, it's been growing 2 to 3x as fast as the rest of consumer, right? And then you look at things like e-commerce and, because people don't want to carry the bag of dog food home, it's like there are 40% penetration rates of e-commerce and pet, which is way higher than anything else. And so the pace of adoption for new products is just a lot faster in pet. And so I think as people start to do their homework, they get there, but it's not the most intuitive thing for people. You still get people say, isn't consumer VC dead? I thought, Apple's privacy changes made CAC costs go up and now nobody can afford to acquire customers anymore. Or, didn't the pet boom happen during the pandemic? Isn't that already done? And, you still get lots of those kinds of questions, but, at the end of the day, it's not for everybody. We know it's not for everybody, but for those who know, Mars family, the Ryman family, they know, and it's pretty good.
When I talk to people about this space, because I've been writing about it and covering it, like, as I call it, the economy of dogs, for over 2 years. And then I tell people when they're just blown away by it, I'm like, okay, so you're interested in health, right? Health and fitness. Walk me through some of the things you do for yourself. Well, I take supplements. Well, I'm like, you ever seen this orange container called Zesty Paws all plastered all over Amazon? That was like a $600+ million exit. I was like, everything you do for yourself, I hate to call it arbitrage, but there's almost this arbitrage if you're keeping your finger on the pulse. It's like this thing that's happening in the human space, it's going to eventually trickle down because it's just everyone, if you talk to them, we all know that everyone's becoming, the dogs are not pets, they're family members, right? So that humanization element. And then even starting at one of the biggest subcategories, so food, the unkibbling that's happening. It's like everybody's like, well, if I'm putting this in my body, why wouldn't I do the same thing for my dog, right? And so I think that really easy unlock of just showing people, here's what's happening, you're just not paying attention. And also it's not really talked about that much outside of people that are, in this space. It just doesn't get, covered as much, aside from Farmer's Dog now, recently announcing that they crossed into the billion club, which is crazy. And then part of me looks some people are like, oh, it's amazing. And there's so many things happening. And then I start seeing John Legend and Chrissy Teigen launch a pet food. Katherine Heigl launches a pet. It's all these, fresh pet is such a huge thing, and everyone's like, I got access to this. I make my own recipes, blah, 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 blah. And so now that's like starting to become more competitive and whatnot. And then, yeah, it's like there's a huge wave of D2C, right? And like not going through these traditional retailers, which are struggling to restructure, like your Petcos and things like that, are trying to capitalize on that, where you had Chewy is, solved the writing on the wall forever ago and has been dominating that space. So it is fun to, like, we also cover the super niche stuff and also the big moves. But I just, for the last few years, being in small business and being in totally different industries, I'm like, nothing gets me more excited than this space. And there's just so many small niches you can carve out for yourself that are just like, we're in the infancy stage. It's not just all pet food and treats, but there's still even tons of opportunity there.
I mean, an $80 million Series B round for a pet screening company, right? I mean, right? It just goes to show you, like, how, to your point, there are so many niches, and it's crazy. I mean, even at Mars, like, most people think about M&Ms, and it's just such an iconic brand. And at the same time, like, if you look at those pet brands like Royal Canin, I mean, they're way bigger, way bigger. And most people have no idea, right? And it's just price at the end of the day, right? I mean, $1 bag, $80 bag, right? It's fairly obvious. And to your point, I think on the pediatric relationship, as my colleague David Howarth calls it, between people and their pets, it really is that kind of human animal bond. And that kind of enthusiasm and passion that you have for your kids, you have for your pets. And that is the essence of any great brand, right? I mean, you think about the iconic brands that you know of, and at the end of the day, whether it's Porsche, right? Or it's something like Royal Canin or M&M's, it's about something that people just love and they have an attachment to that they can't even explain fully, right? And that passion is really the seed of it. And yeah, the pet industry has it in spades.
What are like some of the, I think you've mentioned before, some of the segments, right, that you're interested in allocating funds to and vetted? So there's like pet food, there's the tech, the health. So walk us through some of those categories and like maybe some of those things that you're looking for. Like in pet food, there's so many brands, right? And it's great. There's a lot of transition to fresh food, to raw, all these things. So there's a lot of opportunity there. But I'm also curious, like, at what point is there a differentiator from the product? Is it just become marketing, customer support? Like, just kind of walk us through those categories and like what edge you're looking for within some of those.
Yeah, great question. So I mean, at the highest level, we have three sort of buckets that just try to keep things simple. And one is consumer, one's healthcare, and one's tech. And within that, there's a lot of breadth, but just to keep it simple, consumer, healthcare, and tech. Consumer for us will probably be about 40% of our investments. Healthcare will probably be about 40%, and tech, although it'll run through everything we do in one way or another, it'll be about 20%. That's largely driven because the exits have clustered smaller there historically. I think there are exceptions like Rover that you could point to, but there aren't enough yet.
So when you say tech, just to jump in there, are you referring primarily to B2C stuff or B2B, AI, wearables, or?
These are Venn diagrams that overlap, right? I mean, obviously, like, health is important differentiator even for pet food companies, right? And similarly, like, having tech enablement, whether that's in personalization of the recipe or something else, always helps. But when I think about tech, I think on the B2C side, it's marketplaces like Rover, right? And on the B2B side, it could be, in vet channels. And ideally, if it's a sort of vet SaaS company, like, I mean, there's so many AI scribe companies right now. Frankly, I think there are too many of them, and I worry about differentiation there. But if you're doing that, I'd probably also like to see not just vet, but also more broadly human healthcare services in general potential. We think while scribes might be overdone, there are lots of other things around practice management that you can automate in a scalable way that you could probably de-risk with a vet sort of go to market, but then have a much, much bigger TAM on the human side as well. So those things are interesting to us. To come back to consumer, I mean, historically, pet food is the biggest TAM, right? It is. There's no question about it. I mean, you mentioned farmers, but it's not just farmers. Freshpet, you mentioned Blue Buffalo before that. There's a long history of these large multi-billion-dollar brands, right? And X that are multiples of those. So at the end of the day, if you're trying to make fun math work, I mean, you have to bet on those kinds of companies, right? It just is the case. And in terms of differentiation, I mean, I remember when Mars bought Wrigley before I got there, but I spent a fair amount of time with that business. And, if you talk to people at Wrigley back in the day, they would say, basically focus on the core and every 5 years, launch a new brand for a new generation. And so even back when there was no VC and consumer at all, you basically wanted to sell more of the same thing to avoid cannibalization, but you always needed the next thing, at least every 5 years. And obviously, we're much more saturated than that now. There's much more competition, but usually it's some sort of differentiation around form factor in pet food, right? And on the basis of that, you break through and then you extend the platform and the brand to the other sort of adjacencies that are nearby, whether that's snacks and treats, whether that's supplements, whether that's other types of form factors in pet food. That's the typical path. And I think you'll continue to see that happen just because typically, if a big consumer company like Mars is going to acquire one of those companies, Kind Bar is an example, right? You'd acquire Kind Bar for the bar platform, and then you'd extend into all the other things that Mars has, right? And take that brand across categories, and that's what you're paying up for, right? So as we think about consumer, we'd like to see companies that are a little later, almost growth stage, probably at least 10 million in revenue run rate, and as high as we've seen companies pitch us that have over 150, but for us to make money, we generally want to stay in kind of the 10 to 75 run rate range, such that we think there's enough room left and value left for us to come in, get a reasonable price for us and for the founder, help them win, help them get above that probably 200 million revenue mark and get to a point where they can sell, which I think has gotten a lot later than it would have been 2 or 3 years ago, just given how the market's going right now. But that's how we think about consumer. And so that's more on the product side. We like recurring revenue. So pet food's much more attractive to us than pet products, for an example, that are more discretionary. On the services side, it's harder, especially the four-wall settings, brick and mortar stuff. I think it's been really challenging. Tends to be a lot more capital intensive, more private equity style investments that are late stage. We may make a consumer services investment, but would be biased probably towards marketplaces and other things that are tech enabled that can scale faster, right? So that's consumer. Healthcare clinics, I think, are tough at this point in the US. It's just been so much done. Mars, we did what we did. JB followed, and a lot of PE firms followed after that and drove up prices. And I think there's just been a lot of hard sledding for over the past couple of years. A lot of recaps, a lot of disappointed investors and founders based on kind of what's happened. And some people like the guys at Veg and Steve at Modern, they're doing a great job, right? So I won't paint a broad brush, but I think there are a lot of people that are having a lot of hard times right now. And so even with an antitrust environment that's more conducive than it would have been in the last administration, it's still a tough place to play.
I feel like the vet clinics, from what I've seen, like to your point, it's harder to come in and basically rejudge everything and do total new infrastructure. Like you mentioned Modern, and we also talked to Gil over at Sploot, where it's like we're starting from the ground up. Everything, it's like a one-stop shop. Like everything's considered and integrated from the jump. So it's not like trying to replace laggard systems, SOPs, things like that. And so I think their ability to scale and get up there is a lot faster, exponentially faster than the reverse, where you're maybe rolling up like 5 pretty well managed mom and pop shops and then trying to then go in and how do we, streamline operations? How do we do this? How do we do that? So yeah, I think it almost feels like that's kind of the play now, is just starting from scratch in that space. But there's so many variables. I mean, not to say that other ones don't have that, but I feel like with vet clinics specifically, they've been around the longest as a service. There's a lot of antiquation. There's a lot of distrust with technology and things like that. So
it's challenging. I mean, fundamentally, it's a services business. It's not a products business. And if you think just about the pace of consumer adoption and how fast things could scale, especially across geographies and markets, right? SaaS businesses scale remarkably fast. Products businesses are tough because they're hardware businesses, but they scale fast, right? You get a brand and nothing, can hit escape velocity like a farmer's, right? But clinics, at the end of the day, right? It's buildings, and it's people, and it's zoning regulations, and it's CapEx, and it's a lot of it, right? And so it's just a hard business. And in venture, the rule of thumb is you want to see 100% year-over-year growth generally to be in a place where you can make sense of the math. Growth equity, at least 50% a year or something like that. And to see clinics be built out that fast in the US in the current zoning environment, all the regulation is just really hard to imagine. So I think we'll have a hard time doing that.
Is something like Vets, I don't know if it's vets.com or Vets, but they come to your home essentially. Is that a more potentially lucrative model? I forget the exact name, but I think you know who I'm talking about, right?
Yeah, mobile vet, we see some of the companies from time to time, and I think we're open to the idea, but you know, just the logistics and the supply chain optimization, I mean, the routing optimization and the quality of tech you'd have to make the appointments line up to make the utilization math work is really, really hard, right? I mean, you just think about the simplicity of being able to stack your customers in a building where you don't have to move around at all, right? Think about how much more you'd have to charge if you had to move and see 5 to 6 customers in a day, right? To price the value of your time and then have the tech that's good enough to make sure that you could do that at scale and deliver the kind of quality service you need. And then having all of the instrumentation that you need, not just in one central place, but in all these different vans. I mean, like Tandem or somebody is trying to do. I think it's an interesting idea, but
Logistical nightmare.
it's really hard. One of our venture partners, Brian Hurd, did Vet Pronto, which is one of the first vet companies to enter Y Combinator back in 2015 or 2016. And they had a really hard time doing that and shut the business down. It's not to say it's impossible. Somebody might figure it out. I'm just saying it's tough sledding.
Yeah. So let's just say, quick scenario. I got Collins Pet Food here going on, and I got 10 million in sales. You're keen on, okay, I've passed the first sniff test. You think that there's a way to get that 100% growth in the next fiscal year. Like, what are the things that you feel Vetted Capital is bringing to the table? Because I know you mentioned before in like an interview, I think you said something about like a hands-on value creation, I think is what you said. So what does that look like? So if I'm coming to you and I'm needing your capital and I want to partner up, like how are you helping me get to that next stage?
Yeah, it's a great question. And to be clear, like it's the founder's job to build a business, and I don't want to overpromise here and tell people that we're going to solve all their problems. I do find that founders tell us regularly that when they talk to us, we understand what they're dealing with because we've been there, and in a way that most generalist investors who come from the outside the category don't. So in the case of a food business, on the demand side, if you're at 10 million in revenue, you're probably entirely D2C. To date, you might have gone outside of D2C and you're in Amazon already or Chewy already. I don't know. But if you're doing really well, you're probably entirely D2C at that point, and you're going to be thinking, how much longer should I stay on this path? When should I extend into other e-commerce channels? Which one first? Why? When should I go retail? Which channel should I choose? Should I do pet specialty? Should I do Target, Costco, you name it, right? There are all those sort of questions to figure out. That's just the demand side of the business. And each of those has implications for the team that you need, right? And if you're going to go retail, I mean, all the trade spend, all of the sort of relationships you need with the distributors and the retailers, those are very consequential decisions, right? So having somebody that like Brock, who's been at Petco and been at PetSmart and built several really good e-commerce businesses, advise you on those things is helpful. Pet Labco is an example of a company that he was the first outside check-in and was on the board of for a long time. And, probably will have a transaction soon if you guys haven't already seen it. And, is the example of the kind of thing that I think we could point to and say Brock has been helpful, right? And if you talk to them, they would say the same thing. And I think on the supply side of the business and food, I mean, people take for granted quality and food safety, right? It's a brand killer. Talk to Mars about its experience in China. That's how you lose hundreds of millions of dollars is you have a quality incident, right?
To jump in on that, I just went down a rabbit hole on a Reddit thread. There's like a raw pet food Reddit thread that's got like 60,000 people on it. There was everybody in there who has any form of raw, even if it's freeze dried. Like they all talked about who's called this company, what was their like copy pasting email responses from all the companies, all regarding the bird flu. So like anything that came in that was like under the HPP processing, do they do HPP processing? Do they just dehydrate? Like every brand, like they were just being completely under scrutiny. So to your point, I was just blown away that I don't think I could find a brand that they didn't talk about in that whole process, right? And transparency, it's just so huge. And I think so to your point, there's a demand side, which is obvious, but like that operations component is something that I'm just like, and now with the tariffs are a whole nother thing, but like now with everything, all these headwinds, right? And wanting things to be very transparent, knowing where the ingredients being sourced, like an open farm, that's a big thing for them. Like it's becoming super, super, super important in that, and at least building loyalty, right? I think people more than ever are brand switching, both to just, there's this huge trend with just trying different proteins, mixing up food, giving variety to dogs, and some brands just can't do that. So there's a lot of brand switching, but to build that loyalty, I think you have to go that extra mile, check that box with the safety and the sourcing and the sustainability.
Particularly when so much of that's outsourced to contract manufacturers, especially in the early days, right? And then, like, do you have the right contract manufacturing network, and how national is it? What's the ideal network design to get the right footprint of contract manufacturers for the type of expertise you need? And it varies by the form factor. If you're doing, to your point, Open Farm launched air dried recently, like, so that's a different technology stack to do that relative to like extrusion. You know what I mean? I think it really depends on what capabilities you need, and knowing that, and then just the basics of the supply chain too, right? And getting, what you need at scale in a way that's going to stand up to the capacity and the financial projections that you have. I mean, it's a big supply chain management problem at the end of the day, right? So most people coming in from the outside probably don't appreciate that. And just the fact that we understand, even if we don't open any doors, even if we don't help you solve any of those problems, the fact that we understand what you're dealing with, I think has just been pretty well received. And then, yeah, we're not going to overpromise. We try to be helpful, but we think we can help too.
We try to keep our finger on the pulse, and there's outbreaks and recalls literally every week. I see a different company, sometimes the same company, and there's lawsuits. There's a guy, I think in Oregon, he's suing, I forget the name of the company, but his pet died. He's suing them now. So these things are, it's not easy, especially when there's meat involved. You're trying to freeze dry, you're trying to raw, whatever it is that you're trying to do. Yeah, that's extremely difficult.
It's tough. Yeah. So I'd say that's the consumer side. I think healthcare, we talked about clinics. I mean, pharma is interesting. I think it's getting more interesting than it's been historically. People are starting to want stuff for their pets that's not just a licensed drug that was approved for humans. And I think there's opportunities there. We'll see how that works out for investors. I think historically the exits have clustered a lot smaller than the pet food exits. And so it's been less investable. But I mean, this week, SEBA announced a pretty big recap, valued them at $10 billion. They're the fifth largest player now, so it's not just the big four. That's going to be really helpful. I think if you look at EQT's come in and back DECRA, and so there's some capacity there to do more. And I think when you've increased the scale of the strategics by 50%, and the likelihood of bidding wars increases probably more than 50%, right? And so I think it's getting to be a better place for investors than it's been historically. Diagnostics are tough. It's even more consolidated than pharma. You've got IDEXX, you've got Antech at Mars now, and you've got Zoetis. That's a little tougher place to play. And at the same time, there's a lot of technological opportunity there on AI imaging of radiology of various types, and a lot of companies are doing it. So we think that's interesting.
It's so funny you mentioned that, because I just had this similar thought going back to the humanization element. Outside of my gym, one weekend, there was a DEXA scan van that pulled up, and you get a whole DEXA scan of your body, like $60 a pop, right? Line out the door, everyone just dying to do it. And I was like, guys, it's just one tech, one machine, hop in the van, boop, 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 and get like all this readout. And I was just immediately, I thought, I was like, it's only a matter of time before we're doing the same thing for the pets. They're already doing, like, mobile has been proven that, to your point, you brought up a lot of the logistic issues, but like this is a little bit different just because you're not having to service and do so much customer support. It's very transactional. But I was like, it's a matter of time before something like this happens. But this space, I feel like in all the spaces that we've talked about, this one, to me, and this is more anecdotally speaking, I feel like is one of the biggest laggards. And so it's like, there are quite a few wearable companies. I think some of the hardware and the accuracy is being dialed in. And there's some like new ones, like Pet Pace is amazing, where they can do like pain tolerance and things that are just like, I think those little unlocks outside of like, Fido walked 20 miles this week or whatever it is, like it's these other things that I think are super interesting. And then how you actually aggregate that data help me be more proactive as a dog owner, and, being able to make suggestions on supplements or activities and things like that. So I think that space is really exciting, but it seems like it's further down the pike than all the other ones that we've mentioned. But arguably one of the more exciting ones, in my opinion, is like just having a dashboard of everything, which I've kind of beaten to the ground a lot with Roy. But it is like, it's just, for me as an end user, I'm like, I want to see this. Yeah, I want to see this. Like, this is something, just give me a launch pad. Like, I just want everything in one spot. I don't want to think about it. I'm doing all these, I'm going to the vet, ingest that data, I'm buying from Chewy and just that data. Give me alternatives. If it's meds, like a big thing I think with meds that's interesting is there's a massive movement, as you've seen with raw, to go more holistic, And so I think people want to do more, maybe like you have allergies. There's people who use salmon oil and other supplements. And so playing into that brand story, like all these ingredients in these dog treats, people are questioning, is there artificial? Is there not? Is this good? Like the percentages. And so you get down to a single source treat, right? Like here's an alternative to this med, which is not necessarily a one-for-one replacement, but you're just giving people options so they feel like you're building trust that way, where you're like, hey, I'm not saying to just take this medicine and you'll be great. Like here's everything in one fell swoop for you to make an informed decision to see, what's out there on the marketplace.
Yeah, look, I love the concept. And I mean, I was at Morris, we did Whistle, and Ben and Steve are great guys. And, I think a lot of us have been surprised at how long it's taken for that to take hold. And you talk about wanting the information. I mean, I just think about myself, like I like this, but does it do, and do I actually allow it to do all the things it could do for me? No, it doesn't. And in fact, I don't expect it to. It mostly serves as like choice architecture that invades my space and reminds me if I haven't walked enough or that kind of thing. And occasionally I'll check it a couple times a day. But the reality is, the job to be done by consumer tech like this for a lot of people is at least as much wealth signaling as it is actually wanting the information, right? And I think understanding, like, really at the coalface what people really want from the tech and what they're actually trying to do. I mean, like at Whistle, I remember the Pet Insight project and all the things, all the great things that they did. I mean, like you could use the scratching behavior to detect atopic dermatitis and those kinds of things, right? And then everybody's like, well, that's going to be great. You're going to sell Apoquel off the basis of those recommendations, and it's going to be amazing, right? And I think it's been okay. I don't think it's ever really lived up to like what I would have wanted, and certainly not what Ben and Steve would have wanted to do if I had guessed. I mean, can't speak to those financials particularly, but I would say my guess is it's never quite done what people would have wanted it to do. And at the same time, I do think like people like Tractive and Fi and others are probably built like pretty good businesses. They're not this, right? And they probably won't be.
But earlier, you mentioned birth rates going down, pets are going up, and this is kind of happening globally, right? I think it was Korea or Japan where their baby strollers are now being bought more for dogs than they are for babies. Are there international markets where you're keeping your eye on, or like, this is interesting, where I don't know, the adoption of pets there is going crazy. The adoption of technology for pets is going crazy. Like we're really keen to enter that market.
Yeah, I mean, you've got to be very careful about all of that. I think at the end of the day, emerging markets are the future for any large consumer company, and so they'll have to be focused there. And Mars has been very public about India lately, right? About their focus there, example. And at the same time, I mean, there's a lot of volatility in those emerging markets, right? There always has been. And when the US sneezes, India and other places with a lot of economic interlinkages catch cold. And certainly amidst the nationalist tide of tariffs and everything else that are going on right now, you got to be very thoughtful about that. So we're on the one hand bullish about the global trends, and at the same time, it's always a case by case decision. I think India is interesting. I mean, just the underpenetration story there, it's enough to drive anybody crazy, right? It's amazing how much growth is left. China's been interesting. The demographics are very different, right? I mean, birth rates are a lot higher in India than China. There was the one-child policy, obviously, in China for so long that created some of the situation you're seeing now. And obviously, just the geopolitical landscape makes China tough, right? So you'd have to do that very, very thoughtfully. And I'm skeptical we'll get there.
They don't typically like especially Americans, companies coming into China and trying to sell their products there.
Yeah, it's funny, like I talked about the Mars story. There was this melamine story. It was a very old story, but it was a big quality issue. And Mars, when I was there, we put a global food safety center there that the current chief science officer kind of ran for a while when it was just getting off the ground. And it was really just to ensure safe food in China to help build the brand, right? And I think it's been pretty well received. And so there's some companies that can take a longer view, but you always end up in joint ventures and you never completely own it. And it's logistically complicated. And, it's hard to paint a country with over 1 billion people with a single brush, right? So I don't want to be generalizing too much, but it's a complicated place to operate for all the reasons you'd have to have the right partners. And I think for a group like us, we'd have to have the right partners in any market where we didn't have boots on the ground. And so, but yeah, I mean, there are definitely markets like that. I mean, Brazil's another one that's been talked about for a long time. Have made investments, both because of the if you think about animal health generally, there's just a huge livestock population, right? So, and then there are other places that just have great growth stories based on some of the economic reforms happening. You look at Argentina as an example and what Milei's been able to do. I mean, he's proved everybody wrong in a relatively short amount of time, which is awesome. Yes, we look opportunistically. We certainly have our 2x2 matrix that, the markets that we like. And at the same time, all companies are different, and it's at least as much about the company as it is about the country.
Yeah, the Argentinian president, also El Salvador, but that's a completely different issue. But it is impressive when somebody comes into office and just is able to reboot the country within a relatively short amount of time. I think the logistical red tape here and the bipartisanship makes it impossible. But that's a completely different podcast. That's over coffee. I wanted to actually touch on this a little bit earlier, but you leave Mars at some point, and at what point do you think to yourself, I want to start a VC firm that focuses on pets? And then for those, I don't know either, so it would be interesting for me to learn, what is the process of starting the VC? What is the process of raising a fund like that? I know there's some things you can't talk about because you've explained in the past, but whatever you can divulge and kind of, tell, that would be awesome.
Yeah, so personally, like for me, I left Mars after trying to start a business with them that I ultimately just couldn't get them over the hump to start with me. And I'd been in a situation where I wanted to do something more entrepreneurial for a while. I couldn't quite get there, and I had an opportunity to go back to Coke and had a great couple of years there during the middle of the pandemic. And yeah, I felt like a sort of tour in public service, if you will, if not quite in public service. And I enjoyed that. And on the backside of that, I got an opportunity to have, this experience working as a CEO, my first CEO role in a business that was kind of a consumer pharma company. And it was focused on pandemic preparedness. And we had a couple candidates that we were developing, not just for COVID, but for influenza A and a couple of other, we talked about zoonotic stuff earlier, a couple of other broad spectrum antivirals that would be more consumer friendly than like Paxlovid or some of the other things people were working on. And we unfortunately had a round fall apart in the middle of SVB, which was just really painful. Like literally shook hands on Thursday. SVB happened over the weekend, round fall apart. And it was like, you spend money on legal work over the week to get all the paperwork done. And then they come back and they walk away at the deal table the next week. I mean, it was brutal. Yeah. So that taught me just how risky I think venture and the startups were, and reminded me that diversification and portfolios were nice, right? So I think I loved entrepreneurship. I wanted to do something with a little more skin in the game and autonomy. At the same time, I wanted some diversification. I mean, I've got a family. So I think that was one of the things. And then, yeah, I think I also just looking at the market, I just saw an opportunity, right? As I talked about with David in there. And I felt like we knew great founders, and we saw the unavailability of capital for people that were pretty qualified founders and were ready to build. And we thought that was an opportunity. I also, when I was at that startup, I was really lucky to work for, my board was just incredible. And I wasn't responsible for most of it, but like one of the guys had worked at Arch in the early days, which is one of the OG biotech funds back when it was like the Argonne Chicago Development Company that was formed to spin tech out of the University of Chicago. And he had done just tons of financings, probably 2,000 financings, and had like 10 exits north of $300 million. And, I looked at his trajectory, company building and having a portfolio versus like a corporate trajectory and kind of getting back on the ladder climbing path. And, even if you're the CEO of one of these big battleships, I mean, you just never have these massive outcomes most of the time, right? I mean, maybe you do if it's Amazon or Meta or something, but most of the time, if you're not the founder, it's only so good, right? And you basically spend 20 years standing in line to get to that point where you have a few pretty good years, but you're probably not going to have more than 4 of them, right? Alternatively, I saw this guy who, I mean, like we had other CEOs from big battleships on the board, and I looked at this guy's life and how he'd done it. And he just always had a portfolio. He was just always starting companies, right? And he would incubate the thing and seed the thing himself. And he always had his fingers in probably 10 or 12 pies. And it served him really well, it served him really well. And I think for me, it was just this insight of like, it's up to everybody to choose, but why would I not get on this path if I could? And so that's sort of been the mode that I wanted to be in. And I've thought more and more about how to get there. And is it go build a company first and have an outcome and then go do the fund? Or is it just try to do the fund? And I thought too about just kind of my personal skill set. And I was really lucky at Mars to be in a place where I had a bird's eye view and I could see from the top down kind of what was happening, what they wanted, and understood what they wanted, but also what founders needed. And I felt like there was this gap in the market that I could fill probably better than I could build at the end of the day. And so it was a combination of kind of my circle of competence, where I saw the opportunity, and just sort of a long-term path that I wanted to be on that led me to want to be here. And I love pets, to be clear. I think this is a huge opportunity. It's particularly a big opportunity right now. But in the long future of this firm, if it goes well, it may not just be pets at the end of the day, right? But this is a really good place to start.
It's like I always like to say, life's too short to drive a boring car. And in your case, life's too short to climb that corporate ladder. I love the thought logic there, especially because I've sat between like being on the media side and also, like you said, oh, should I go start my own thing, then go into the, portfolio side, the VC side, or should I do the vice versa? And I've had that question with myself so many times on the media side, so I can completely relate. And yeah, it's that choice, right? And and I do come back to that saying to myself where it's like, someone's like, oh, just get just get a RAV4 or a Prius. And I'm like, life's too short, so
Yeah,
I
for me,
love
it's
that.
not cars. It's more just like wanting to work with people I like and do business the way I want to do business with, enough of us or the time horizon that you're not, for anybody that's ever been in the corporate roles, you just know, like, I mean, at best, you've got a honeymoon period where you can really get stuff done. And sometimes it'll last 12 months. Sometimes it'll last 6 months. If you're lucky, it's 24 months, but it doesn't last forever. Right. And everybody goes through that cycle. And, eventually you get to the point you realize you've helped make other people a lot of money. And, if you're lucky, you have some skin in the game, but in some places you don't have very much, right? And you never as much as you'd like, right? So there's no substituting for equity, and risk comes with it. But you get to a point where you've basically gone to school, as an old mentor of mine likes to say about going and working in big companies, at least as much going to school as going to school is going to school, right? I think after you've done that for a while, you've learned enough of where the big problems are, you've developed enough skills to be able to contribute and go bet on yourself.
Yeah. I think it was last week we had Kevin Cohen on, who's the founder of VetRec, and he told us that initially they got into Y Combinator, and it was for some restaurant app or platform, and they eventually switched and pivoted to VetRec. But the people at Y Combinator, they're, for lack of a better term, they're like, oh, this is crap. Like, this thing you have now is crap, but we love you. Like, we're invested in you. And they brought him on, and eventually he did, he turned it into a winning product. I'm interested to kind of learn when they're pitching you, hey, we have this new product, we have this new service, this is going to kill it, we're making X amount of money. How much of it is the product and the service, and how much is it you saying this team or this person, it's a winning team, like I wanna ride this train with them?
Great questions. I mean, for us, it's both, and it has to be both. And at stages we're investing in, you can't just be betting on people because you have too much data you'd have to ignore, right? I think when you're writing first checks, if you're at YC and you're doing pre-seed, you really are betting on people at the end of the day, and you should know that, and you shouldn't pretend that you're betting on anything else. But if you're betting on a company that's at Series B plus and they have north of 10 million in revenue, you know what the gross margins and contribution margins and all those other things look like, and you can't ignore that, right? And you have to make a really detailed qualitative decision about the composite that you're looking at. And even then, if you like all of it, you still have to be prepared for the contingencies too, right? I mean, we're not doing buyouts in private equity where there's going to be an operating partner and that person is going to probably be the CEO of that company in the next 2 to 5 years, right? And they know that from the start. So we're not doing that. But you have to be thinking more in that direction than you do about just betting on people. It's a lot more than just betting on people at our stage. And at the same time, the founders, like, absolutely critical. And we don't bet on bad founders, right? And we've had an opportunity where, like, a lot of the numbers look good and there was a pretty good track record. And at the same time, like, we just couldn't get excited about that person and working with that person. And if you can't, I mean, like, just trading somebody out at that level is just such a big thing in the course of company building that, like, even if you do it flawlessly, there's going to be at least 6 to 12 months of disruption, right? And when you're talking about the growth rates that we're talking about, that's a very big disruptive force in trajectory of that company. So those are risks you can't.
What could make, if you guys, you like the product, the service, you like the little sector or niche that they're in, and you like the numbers, what could be about the person that would make you say, no, we're not interested.
Character,
Character?
character. Yeah. I mean, at the end of the day, there's a lot of referencing of people. And, like you talk to enough people, enough other founders, enough of their other investors, and you find out, and lying in particular, I think playing games, and putting you in a situation where they're just constantly trying to pitch you against other investors and, you know, investors that that in some cases you were going to do a round with together and you hear different things from different people and the stuff gets old really quick, right? I mean, life is long. We're all probably going to be doing different things 10 years from now, but in the same sector with different companies and like those things people know, right? So yeah, we want people that are earnest, ambitious, gritty, intellectually curious, but like earnest and the kind of people that you're probably going to be getting in the trench with these people for at least 5 to 10 years, right? And at the end of the day, it's all about people, right? And if you don't want to be in that trench with that person, making calls on their behalf and helping, like life's too short, right?
Yeah, I can I can attest to that. You know, jumping in bed air quotes with a couple of co-founders in the past that has led to just not only the ruin of the business essentially, but the ruin of that relationship as well. Whereas maybe before you were friends and it just the whole thing just fell apart both on the business side and the relationship side, and and then it made you just miserable for the next year or two. So it's not worth it from every aspect that you can possibly imagine. So yeah, I definitely get that.
I'm curious. I know we're butting up against time here, and I know you've laid out your three buckets that vetted capital is focused on, but perhaps maybe outside of that, or maybe within that, like drawing it down to one single thing, right? It could be trend, insight, something that happens from in the next 3 to 5 years, you maybe guess. Like, what is something that you think that you're most excited about and that you're keeping your finger on the pulse, or that you think is going to be a big thing that maybe is kind of a sleeping giant at the moment in the pet space?
Yeah, that's a good question. Honestly, I think one of the nice things about the pet space, and hopefully this isn't too much of a non-answer, but we talked before about just how human leads and pet lags in some respects. And so there is this ability to see it coming, often for a very long time. In some cases, that gets you into trouble. I can remember at Mars, like the 23andMe sort of genetic testing, right? Where Mars literally incubated one of those businesses and still has it. And that's a tough business. I mean, 23andMe just proved it's a very tough business no matter how much capital you have. And so I think if you're just trend spotting on the human side and trying to chase, like it can really get you into trouble. And so like that's not a good idea. And at the same time, there's so many things that get de-risked on the human side with a lot more money that you can watch and figure out what is working and why. And so I think we like the fact that it actually isn't the latest technology most of the time. It isn't the latest, greatest innovation per se. It's really more about the business building that matters and the people that do that. And so I wouldn't say it's really trend chasing so much. I think the trend that we talked about that matters is the demographic trend, because demographics are destiny, right? And so like it makes me think that there is a wave that it's been going for a long time that will continue. And the question is just where are the best founders building against that? And usually, as we've talked about, it's the non-obvious things, right? It's not the latest, greatest AI scribe. It's a very unsexy business that somebody's just figured out like people really just need this thing and I'm going to build that thing, right? And the people that have the grit to do that and stick with it for I mean, by the time we're looking at them, it's in at least 5 years. It might have been 8 years already. Like that's a long time. If they're that committed and have proven that they can build a business over that kind of trajectory, they're probably somebody you want to talk to.
Demographics or destiny is going to be the thumbnail, by the way.
Love it, man.
I love that one.
Well, guys, it was great talking with you. I really enjoyed meeting you, Colin, and Roy. Great to see you again. Look forward to that, fixing all the world's problem beer session here.
Thanks for coming on. We really appreciate your time. If people want to reach out, where the best places?
Yeah, so there's a get in touch contact form on our website where you can send a deck. Feel free to go there, send stuff our way. We try to be pretty responsive and get back to you within 24, 48 hours. So feel free to reach out then. Always happy to connect. My LinkedIn is another place that you can reach out to us.
Very cool. Charlie, we really appreciate you coming on and talking to us, and we'll have to do it again sometime soon.
Look forward to it, guys. Have a great rest of the week. Talk soon.
I appreciate it.